more and more indicators. Now with the Federal Reserve's crucial minutes, which are just around the corner, all eyes, of course, are on the state of the US economy too. Bigger concerns are on the horizon. The inversion in the bond yield curve, the threat of recession is lurking around the corner in more ways than we've seen in the recent past. In the last 100 years, in fact, whenever the bond yield curve has inverted, the US economy has been hit by recession, and that recession has hit in the next 9 to 22 months after that curve has inverted. So now, GDP is clearly not the sole criterion for declaring a recession. There are many other factors that come into play. Let's take a look at this special report that my colleague Gulshan has put together to help us understand what's going on with the possibility of a US recession.
Is the US economy already in a recession? Or will widespread fear of recession inevitably lead to the undesirable? And finally, can the US bring down inflation to 2% without hurting the labor market? These three questions are weighing on everyone's mind. As any suffering in the world's biggest economy will invariably send ripples, even shockwaves across the globe. Ominously, most experts are quick to drop the R word, almost guaranteeing recession in newspaper articles and TV debates. However, declaring a recession is almost as difficult as predicting one. The Atlanta Fed's GDP Now model has estimated a 2.1% contraction in the US economy in the second quarter of this year. If we were to take this data at face value, and the data has been highly reliable over the years, then the US has already technically entered a recession. Here's the catch. The traditional definition of recession has lost some shine over the years, as GDP alone cannot diagnose the health of an economy. Take, for instance, 2001's recession. A recession was declared even though the GDP did not decline for 2 consecutive quarters. However, the unemployment had risen to 5.5%. Nasdaq lost more than 75% of its value, and industrial production fell. So who is the supreme authority on deciding what possibly nobody wants to hear? It's the National Bureau of Economic Research in the US that is considered the official arbiter of when recession starts and ends. Going by job numbers, the US is certainly not in a recession, as the economy is adding hundreds and thousands of jobs every month. The unemployment rate is below 4%. This factor alone stands in the way of a recession. Industrial production too has been rising until May. Some economists observe the yield curve, but the gap between the 3 months and the 18 months rate has also not inverted. This is why most economists are suggesting that the recession, should it come, will be a mild one. With Gulshan Sharma in Mumbai, Stacey Pereira for ET Now.
That's putting recession in the US in perspective, but let's further break this down. Mythili Bhusnurmath, consulting editor at ET Now, continues to be with us here on the show. Also joining us now is Nick Parsons, the head of research and strategy at Thomas Lloyd. Thanks for staying with us and joining us. But let me come to you first, Nick. US futures have slipped. Bond yields are rising higher. Oil now hovering below $100 a barrel, which suggests that demand is falling. The economy of the world is slowing down. So if you consider the last 100 years, I was telling our viewers this, whenever the bond yield curve has inverted over the last 100 years, recession has definitely hit the US economy, and it's hit within the next 9 to 22 months. So even if we've hit it technically in the US, how close are we to actually hitting recession in your understanding? And if so, how is it likely to play out in the markets?
Well, good evening from London. I think we will find that in spring of next year, the NBER will move to declare that the US is in recession. And the reason I say that is by then, I think we will have seen increased job losses. We will have seen a falling housing market. We will likely see the year-over-year rates of retail sales and industrial production moving into negative territory. And I think all those things together will be enough to prompt the NBER to declare a recession in the first quarter of next year.
Fair enough. Mythili, whenever inflation has risen above 4% in the US and unemployment has dipped below 4%, it has almost always indicated economic overheating there. And typically during a recession, of course, we see the economic engine struggle. People start getting pink slip as companies sell less of whatever they're producing or offering as a service. And that way, the country's overall economic output, that takes a dip. So this time, of course, we're seeing the impact of the pandemic play out. But would this recession, in your understanding, be different from others in the past? Because jobs haven't been hit that hard. How different in nature do you think this American recession could be?
I wish I could answer that question for you, Vikram, simply because as an economist myself, I have a very poor opinion of my fellow tribe of economists in predicting recessions. In fact, if you see, given the uncertainty that we see in the world today, it would take a brave man to stick their neck out and say, okay, I'm sorry, I know Nick did say that we will declare a recession in the first quarter of the next year, but it's much, much more difficult than that because there are so many moving parts. We really do not know if perchance the war in the Ukraine were to end, things would change dramatically. Who knew COVID would hit us? So I would be much, much more hesitant in saying so definitively that every time the yield curve, there's an inversion, every time this happens and a recession necessarily follows. Yes, the US first quarter did see a decline in GDP, and 2 consecutive quarters of decline in GDP does normally signal a recession, but we really cannot say. But all we can say at the moment is that things are very uncertain. The US Fed is determined to get inflation back onto that 2% mark. And so they are going to raise interest rates once again at the Fed meeting at the end of this month. But whether that will necessarily lead to a recession, I'm not sure. Certainly, we will not see the kind of growth that we saw in the past. But whether it will mean a recession, I'm not very sure. I really would not be able to say yes for sure, when for sure.
Nick, what do you make of it? Because like I was telling Mythili, the labor market in the US, it has remained resilient, quite strong, despite the fact that inflation in the US has gone up to the highest level in a span of more than 40 years. And the latest employment figures in the US, they'll be out on Friday. Whatever those numbers are, these resilient employment numbers will, of course, give the Fed more room to raise interest rates. That's the expectation. And if so, it does spark off recession fears that much stronger, because another 75 bips higher in July itself from the Fed is more or less expected. What are your concerns right now when you look at the employment figures in the US and you consider the prospect of recession there? How do those two correlate in your head?
Well, let's try and square this circle of the US labor market and recessions. You're absolutely correct that traditionally recessions are accompanied by rising joblessness, falling employment, if you will. And the reason we look at employment levels is because that tells us something about the money that's in the consumer's pocket. It tells us that about the money which is available to be spent. And of course, if fewer consumers are in work, then there's less money to be spent. But actually, inflation is having a very similar impact on the labor market, because even though the actual numbers of people in work are not declining, we have not yet got rising unemployment. What we have got is falling real incomes. So that those people who are in work, and yes, there are lots of them still, and let's celebrate that fact, but those people who are in work are finding that their purchasing power is falling, their real incomes are declining, and GDP numbers are measured in real terms, not in nominal terms. So in fact, inflation, through its impact on real disposable income, is having just the same pernicious negative effects that a rise in unemployment would. So I think it's possible to have a recession this time around alongside low unemployment rates, simply because consumer spending has hit just as hard as if there was a rise in unemployment.
And that's what I want to take to Mythili. If you're talking about consumer spending, perhaps it's a fear factor that is at play. There is so much talk about recession. Certainly, there could be an inventory pile-up because consumers are fearful of spending. Can a recession actually happen because of fear factor, Mythili?
Oh, well, the fear would definitely play a part. But remember, Vikram, the US has a tremendous advantage that no other country really has, that the dollar is the international reserve currency. So if the US really wishes to ward off recession, all they really need to do is do some more of that helicopter money. The Fed can even if the Fed does not want to ease, you could always have the US borrow more money from the rest of the world, as it were, by simply raising more money from the rest of the world, printing more dollar notes, as it were, and then distributing that money and pushing up demand. So the US has many things in its armor that other countries don't have. So even if there were a fear of recession, the US could ward it off in a way that other countries in the world cannot. So that is what we need to bear in mind, because if the US were to go into recession, the rest of the world will be critically affected. And we do not have the luxury of the US of having an international reserve currency. And I think that's what the rest of the world should really be worried about.
And Nick, we've been talking about the strength of the US dollar, and of course, the rupee is declining on the back of the strength that the US dollar has gained because it's a safe haven currency. But also, besides that, there is the timing of a recession to consider, the cause of it, the depth of its impact, and how long it could possibly last. There could be surprise elements within a recession. If I remember correctly, the biggest recession that we've seen after 1948, the Great Recession, it ran for about 18 months, a year and a half, from December 2007 to June 2009. But regardless of how long this recession may last after it sets in, this time around, have we factored in much of it? Do you think that we've done that? Do you think we have surprises, on the other hand, in store for us, especially when it comes to market action?
I think one of the things that's going to complicate the policy response this time around is the likelihood that the Democrats will lose the midterm elections in November. Currently, they have a wafer-thin majority, but even with that tiny majority, President Biden was still not able to bring his Build Back Better program to fruition. He couldn't get it through Congress. And his political position is going to be significantly worse after November. So I think it's going to be very difficult to have a fiscal policy response. I simply see no chance of that helicopter money that your other correspondent was mentioning because of the political situation at home. So if we're not going to get if we're not going to get a fiscal response, can we get a monetary response? Well, the markets are already suggesting that the Fed is going to have to pivot next year. The market is saying that the Fed will actually be cutting interest rates 3 times in 2023. That's a huge turnaround just within the last few weeks. So the market is saying the Fed is going to have to pivot and the Fed will be doing the lifting for the US economy. And that's why we've seen bond yields falling. And that's why we've seen some support coming through to equity markets, even as we see deteriorating economic numbers. So the market is telling you that the Fed is going to cave. And then when we look at what the timing of that may be, well, of course, it won't be at the next FOMC meeting because we're going to have a 75 basis point rise in rates. But remember, the Fed has its annual offsite meeting at the end of August. So all the Fed go to Jackson Hole and they have the offsite meeting there. And it could well be that that will be the focus of market attention when we get the confirmation that we're going to be seeing a Fed prepared to offer support to the US economy. So that's how I see things playing out near term.
Timing is of the essence, and when exactly the Fed decides to pivot is something to watch out for, considering that we are on the possible brink of a recession. Thank you, Mythili and Nick, for joining us on this discussion to understand the possibilities, the ramifications, and understanding the basic nature of this recession as it plays out.